4:05 here on the West Coast, 7:05 on the East Coast. Rod, if you're ready to go, I'm going to go ahead and read our disclaimer.
Sounds good.
All right. Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Do your own due diligence. So, this is our first space of the year. We wrapped up last year with a newsletter, but didn't post any sort of discussion on it afterwards. So, thought maybe we'd start off this chat with a little bit of a recap of last year, as well as with discussion on where the market stands today and what we anticipate going into this year. So, Rod, if you'd like, I also pinned those two reference materials in the nest as well, so we can check those links out. Anyone who's a listener is able to access that material as well. But go ahead.
Yeah, so we can I guess we can just kind of briefly recap 23 and then talk about 24 and then whatever folks want to talk about. If anybody wants to request to speak, feel free. So, I mean, look, 23 was you had a year where the end of 22, October 22, sentiment had gotten pretty bearish broadly in equity markets, in the real economy. And I think that we could all sum up 23 as a year of resilience, economic resilience, at least in the United States, and thusly in United States-based equities. We, had the brief bank crisis, some just extraordinary. I guess like 23 kind of highlights how powerful the United States powers that be are. The massive amount of fiscal spending that's really made it almost, it's like, can you have a recession in an environment where the country is just pumping money out like it is? It's clearly, we were wrong. Those of us like myself who were expecting economic recession didn't get it. I think, as we got late into the year, especially the last couple of months of the year, I mean, we felt it multiple points throughout the year that euphoria returned. It returned in kind of Jan, Feb, when so many of the stocks that had gotten really beaten down over 22 went wild to the upside. The things like Tesla that had gotten down to $100 and then decided to add multiple hundreds of billions of dollars of market capitalization over a few days because of the sheer volume of retail money flows into that and other securities. Not just retail money flows, but that one in particular is a retail money flow favorite. The summertime, the euphoria, and then really the November and the December euphoria now that's kind of was tipped off from the Powell pivot, so to speak, that happened at the last Fed meeting of the year. So very much to me, I think that the issue was that I think of cycles as typically they go to one extreme and then they come back and they don't stop at the midpoint and return to the extreme, but that seems like what we've experienced. We got back to almost a normal baseline, which like October 2022 was almost like that from an equity like market. We got down to, I think, a 15 times earnings multiple on the S&P 500, which would still prove to be the highest ever multiple for a trough, if that was in fact the trough of this cycle. So my thinking is that it's unusual to go from a euphoric bubble back to the midline, so to speak, back to a median, not actually go back to the downside. I don't think we ever got that. Certainly not in a lot of parts of the U.S. equity market. And now we're back, kind of snapping the rubber band right back toward the euphoria again in many spaces within the U.S. equity market, it feels like. So maybe we'll have, in fact, the roaring 20s that some people want to prognosticate about. There's going to be massive upticks in productivity and in health, and thus customer lifetime value because all the customers are living longer. I don't know. I mean, I'm a little more skeptical. Like mathematically, we talked about it in what was it, the last book and review of the year, I think it was, the research out of AQR kind of showing what is needed for the next decade to be uh, at the same level of return of this past decade. And it's just an extraordinary lift if you're talking about, again, chiefly US equities. So, we start with very rich valuations, doesn't mean they cannot get richer. It's not a great place, I think, for people who are trying to make long-term investments. I think it has just the last couple of years really. I read Ian Bezic. He's an investor who he's operating out of Central America, so he has a little bit different worldview. But I saw his kind of year-end reflection, and I felt very similarly to a lot of the things that he had to say in his year-end. So I won't rehash it all, but you know, investing with a margin of safety is still, I think, I know I forgot that in 21 and 22, um, perhaps to an extent 23, but I think there will be a reckoning for people who flaunt the notion of fundamental investing and margin of safety investing as this kind of rebubble runs out of gas, is what I expect to happen. Because either you need very real economic improvements in productivity that AI will drive very imminently. People need to realize those things are improving businesses' performance, making their margins higher, whatever. If we don't start to really see that, I think that this mania that allowed much of 23 to pencil over, the banking crisis um, and whatever else. Obviously, to start the year, what is it, the second trading day of the year? We had a big sell off on the first trading day uh, in at least the Qs. I mean, it's also noisy now too with the year end and the start of year because of how, I don't know, maybe it was always this way, but it just feels accentuated. The whole notion of, well, now it's January, so I have all these winners that I want to realize my gains on. I want to sell them in 24. I didn't want to sell them in 23. And sure, there's some time value of money calculation there. Realizing the taxes 1 year earlier versus later has, roughly 5%, four and change, whatever the discount rate you want to use on that. So I get some of it, but I mean, start off the year, most indices down. I mean, for me personally, my shorts had been getting squeezed like crazy for the last few months of the year. So I really appreciate this because my longs seem to do fairly well to start the year off these first 2 days. My shorts did even better. So maybe 24 will be better for me. Joe, I'll pause there. How about you?
Good stuff, Rod. Yeah, I put in the nest also the two Bloomberg articles and use this as an opportunity to bring those up. The first one was here's almost everything Wall Street expects in 24. This is written by Sam Potter, and it's a pretty good
That
story.
one's great because
Yeah, go ahead.
it slices up literally snippets from dozens of institutions, dozens of themes and asset classes. So you can really look at whatever it is you want, like that's your area of focus right at that point. So it's a great article. I think Joe, you have the archive link so anyone can access it
Yeah,
if
so
you don't
anyone,
have a
even if you don't
Bloomberg
have a Bloomberg subscription, you can pull
sub.
that up. It is a lot to digest. I mean, it would take hours to go through all of the different funds' opinions on the year, but great to have it all lined out in one area. This would be the kind of article that I would consider punching into Chat GPT and asking for a condensed version of it and seeing what they say, because there's a lot to put together here. And then the other story, everyone got burned. Wall Street missed the, let's see, stock rally of 2023. I have to do a capture to pull this one up. Let's see, fire. I have to select a fire hydrant. Oh, in the Golden Gate Bridge. Where is that? There it is. Yeah. So this one's by, let's see, Liz Capo McCormick over at Bloomberg as well. So yeah, just pretty much talking about how Wall Street didn't really do as well in 23 as they could have, right? This is another year where indexes kind of outperformed analysts. And yes, one chart here in the story, 2023 year-end forecast as of December 1st, 2022 says that analysts went into the year with a gloomy outlook for stocks, but the S&P 500 rallied past all those bearish forecasts. So pretty good story as well. That one's much, much shorter. You could read that one 10, 15 minutes, but good stuff. Dylan, asking to speak. I'm going to bring you up as well. How's it going, Dylan?
Hey, how are you guys doing tonight? Rod, it's great to be back in your space. I actually took a break from spaces for quite a while.
I reduced my Spaces participation rate pretty meaningfully the last several months. We'll see what we decide to do for 24 from like our programming side of things. I think there is a such thing as, too much noise and information. You can get bogged down and kind of stretch yourself, too thin. And I think going back to what I was saying about Ian, like I feel like when you're in spaces, that's time that you can't give your full attention to maybe some other things you're trying to work on, perhaps reading up on some other industries or companies. And yeah, I mean, like I'll still listen to them from time to time in the background, and I love to have a good conversation if they're going on and listen in on those. But sometimes it's just too much jerking each other off and like, come on,
There's a
I don't need
ton
to
of
hear
that.
you touting how wonderful you are at life. Whoever insert name
Well,
here.
well, you know what I realized on FinTwit is there we are surrounded by a bunch of people who don't actually know, but they come off like they know. I mean, again, no one knows anything, and we're all just guessing, including myself. But I was amazed when I started looking back at people who I thought were investing gods. I was like, God, this guy, he has to be killing it. And then I don't know. I cut my spaces down. I think there was a lot of I think Wall Street is filled with a lot of fancy salesmen, a lot of salesmen with very fancy suits, and I think that's what Spaces is. I think Spaces is filled with a lot of very
There's some of
smart
that.
people who
There's a
are really
lot
good
of that
salesmen.
in the industry, 100%, and there's a lot of the people using this platform and others to market their products and services for sure. And that's one thing that I want to reiterate. Like, I, I work for a private investment fund. We don't solicit outside capital. We have no interest in outside capital. So it's a wonderful spot to be. And I understand if you were trying to attract outside capital, that's part of your game. But like you said, Dylan, we could sound as smart as we want, and the reality is there's only so much we can know. And I think that's something I've come to appreciate a lot in the last couple of years. Is something that both Buffett and Munger, I think, have spoken a lot about. Of really stay within your circle of competency, your wheelhouse. I think an issue I've had, I'm sure others, is that you're learning about a new sector or industry or whatever, and you kind of think you know more than you really do, and it's only after maybe realizing a loss on it, or things not going the way you want, that you realize, wow, I'm so low on this totem pole of knowledge. It's going to take me a long time to get to the top. And unfortunately, there's a lot of the Dunning-Kruger folks, running around on Twitter who are very low on the totem pole, but they are going to shout and tell you that they are on top.
Oh, there is no one lower on the totem pole than me. I was talking in the DMs today with someone, and basically he just goes, "You don't know anything." He goes, "I don't know how you keep getting these things right." And I was just like, I just read books, but no, it was a classic example of I don't know everything, and I always talk in absolutes as if I do know, and I try to just reflect my confidence in something, but in reality, we're all just guessing. I guess one thing I wanted to bring up, since this is a financial market space, do you not get bullish when you see when you think about 150 basis points in rate cuts for 2024 and maybe 150 basis points in rate cuts for 2025? Does that not get you excited, not only on the economy, but on financial markets?
Not me. I don't. I don't see why that inherently means that multiples should expand further from already extreme levels. But I mean, I've thought that much of the market was very overvalued since like 2017, frankly, and I still feel that way generally about U.S. equities. Much of the market remains historically overvalued. I mean, we're not talking 2+ standard deviations, but we're not far from 2. So can that extreme stretch further? I mean, that would be the most painful. That'd be a really painful 24 if we get a rehash of 99. We get some more incremental bullish, whatever it is about AI. Somehow a use case comes into being for cryptocurrency, and then we just get this fed off the gas, this massive reflation of asset values, and it just then things go really bad in the real economy come 25 plus. I mean, I hope that doesn't happen, but look, that could be a right tail, short-term right tail outcome that leads to the blow off, 99 into 2000-esque boom bust.
I will say one thing. The 9-week rally we had was quite sharp. I was largely in bonds, so I didn't catch nearly as much of it as I wanted to. But given that you thought equities were expensive or you thought they were overextended since 2017, I tend to share this opinion, although I keep invested in financial markets. Do you remember 2018? And maybe you subscribed to this. It was David Einhorn talking about equities were in a bubble. Has that been your thinking since 2018, or is that too extreme to say, to use the word bubble, going back to 2018? Because they really did ramp. If you look, and again, I was in college, so I remember this from college, but if you look at where equities were valued at in 2015, and then you look at, 2017, 2018, I mean, they just went straight up, and how investors looked at earnings per share or PE ratios, for example.
I mean, look, if you have real underlying EPS growth that comes in at what analysts think, what consensus has on the sell side right now for the major index, S&P 500 is still, we're talking double-digit earnings growth. That's huge. If that were to really come in 24 and in 25, like I mean that right there is the justification. If earnings can continue to grow like this, which I don't see, the math just, I can't get it to square in my head. The notion that corporate earnings can continue to grow at those levels, corporate margins, while somehow there will be a return to flat at Fed target. Yeah, no, I don't know. I don't like to be, and look, all that means to me is I just have to look in different places. I just have to go where the bubble isn't, because I'm not going to rush into the bubble, right? That's not my style. It's not me. I mean, as someone who's maybe an astute trader, of course, can make wonderful returns rushing in and out of the bubbles. But I mean, look, you mentioned you were in like bonds. I mean, my portfolio doesn't turn over all that much at this point. I feel pretty happy with my positions, even though I still have, I think, the habit of holding on to them longer than needed, especially with the personal background context that like 95% of my assets are in IRAs. So, the risk or the tax implication of transacting is not what it is for taxable accounts. But like I still very happy with most of my core holding. I post quarterly my quarterly like positioning, and you'll notice it doesn't change massively. It shouldn't change massively, at least for my investing style. It's not going to change massively. But I mean, I still feel like the stuff that has gotten destroyed, the value that's gotten utterly mangled by NASDAQ 100 on a relative basis, like there's nowhere for that to go but up. I just can't see the continued outperformance of growth versus value at the clip we've seen. It's absolutely not sustainable, but gets back to that point I just made. Could this be a melt up bubble type scenario? People want it to be. Way too many people want it to be, and that's not a good thing. It's very, very worrisome. I mean, I haven't sold really anything yet to kick the year off, but like PBR, I almost trimmed a little bit today. I did not, but some of the Latin American oil companies have been up a lot. I still think they're relatively attractive. But all that means to me is that maybe I need to trim the position a bit, and reevaluate if I want to wait to get as overweight as I am. Like, but to me, like wholesale, I don't know. I don't find myself selling in and out wholesale on a regular basis. So, I mean, to each their own. Everyone's different. I'm talking about my personal account, not any sort of managed account. So I can do whatever I want. And that includes underperforming the indices horribly the last 2 years.
No, and I understand. What I do is I trade my entire net worth, um, with all of it gets traded with all the liquid. The other one is cars and a boat, but no, and then I don't fear paying short-term capital gains. So plus your portfolio is a lot bigger than mine because of your excellent trade on GameStop. So you don't necessarily have to be as risk averse as someone of mine. And then also we have an age component, that makes a difference. But no, just general, you know, okay, so we're not going to agree on, basically the Fed. Have you thought about anything change with the economy? I know a lot of people thought, we were going to go into recession last year. It looks like the soft landing is going to be inevitable. I'm just wondering, does that make you want to go into any sectors that maybe, I'm not talking about growth stocks, for example. I'm not talking about just YOLO into Nvidia, but is there anything that you like if the economy continues to perform as it is? And I'm talking about, let's say we continue to grow at 2% real.
Well, energy is completely mispriced as our like if if we're not having a recession, then why, the oil speculative positioning is the net long in oil is the lowest it's been in over almost 15 years since GFC. So if there's not going to be a big recession, then it seems to me that everyone who's short oil is offsides. And while I understand the concerns about shale supply, and then, is it more that we now have a bigger problem on supply versus demand? Well, if the concern about demand diminishes, that would tell me there's perhaps meaningful upside in things that are exposed to that. In materials seems like there's some opportunities in there as well. Energy mats. So like you've got like a soft landing almost everywhere except for then like these kind of pieces of the real economy where it seems like to me they're not really priced for anything but recession. So I guess that would be the mismatch is if you maybe look at those sort of sectors that are still pretty out of favor and not so demanding. I mean, again, if your duration is trying to trade over months or at most a year or so, then it's obviously a very different approach. So I I mean, I still actually think China, again, if in fact the outcome is what we're kind of articulating, that Fed lands the ship, the U.S. economy is healthy, robust, and thus drags the global economy along with it. Uh, you know, the China like bearishness and negative sentiment level and absolute level of equity kind of values there would tell me that you're going to probably have a balance. And I'd shared, I'd gotten some. Again, it's not an investment. I'm not trying to invest in China per se, but I want exposure to some of these equities. So I have call options on JD.com. I have them on C Limited, which is broader Southeast Asia, not China, and not just Southeast Asia, but that sort of stuff that's gotten beaten down. That you know, thinking again about the dynamics of sell into the year end, and now we got to turn around and buy. I'm inclined to think, and some of those contracts are very short term. Some are 6 months, some are 12 months. But I feel good about if that plays out, then China ought to outperform the U.S., for example, from an equity market perspective over 24, not from a real economy perspective.
That was something perplexing, as I was talking with my family for Christmas. Not every index. India, France, German, America, these indexes are at all-time high. Major indexes are at all-time high, but China isn't. And then I remember thinking, well, China must be the screaming buy. I have no China equity exposure. I've been debating whether to go back into equities. I got burned the last time I was in Chinese equities when DD Kashing. I don't know if you remember that, and it was Full Truck Alliance. They had their IPOs, and I lost a great sum of money. Although, in fairness, overall my net exposure, my net gains from China have been phenomenal. I missed the memo on that one, but when I look at that, I go, yeah, that's the one index that is lagging. Maybe that is value because Rod, here's where I'm at. I don't know how I'm going to allocate for 2024. I have absolutely no idea what am I going to do for this year, and it's pretty upsetting, because it's like, okay, you think you have an economic thesis, and then you don't know how to translate that to financial markets.
Yeah, I mean, again, it gets back to what game are you playing? So, it sounds like the game you're trying to play is very, very kind of shorter term. So I get, that. And I mean, I just think it's harder. It's just inherently very, very difficult. That game is a harder game. I'm not good at that game.
No,
I mean,
there's a
I
lot
still
to be
feel good
said for being
about
a
stuff
long-term
like,
investor.
what's that?
There's a lot to be said about being a long-term investor, and certainly some of my what I thought were excellent trades turned
So
out to
I
be
guess I would like
horrible
pose this
investments.
question. Is it a mistake if you're a long-term oriented investor, you typically have a holding period in plural years, if you're old enough into the decades, like, but then when you see stuff that's just like, was Buffett wrong not to sell Coca-Cola in 99? I think so. And I just don't like never sell. I like when I say, yeah, have a long-term view, it's not to say like you should never, be reducing the position or trading around the position. I mean, I find myself guilty of it, and sure, you could argue there's probably over trading at times, but like some stuff I don't know. And I guess I worry because so many people, this is the soapbox Joe's heard me get on before, but like so many people have been rewarded for being reckless for so many years and they've not gotten washed out. The tide has not really come out on them. So I'm inclined to think, look, the notion that we get a silly melt up type thing, the greed, everyone is just racing and clamoring, and we get a 99 redux where you have to sell the real companies you own because you have to buy whatever shiny object is being flaunted on CNBC at all. Like, it would not surprise me. Nothing should surprise anyone at any point at this point after the last 3+ years we've lived through. So that worries me because I think it's very bad like medium term, longer term if we get that. But I don't know. I mean, there's a lot of discretionary stuff, I would say, if you are of the view that you seem to be, that we're going to have this soft landing and the consumer is going to do well. We're not really going to have a big uptick in unemployment. The capacity to spend is supported by strong underlying housing prices. So many, boomers have their homes free and clear. Thus, they really have shit tons of money they're sitting on. If they ever wanted to tap it, yada, yada, insert narrative here. Like, I would think that's a pretty beaten down space. I mean, a lot of the stuff has already run up off of the bottom, but there's probably a lot more room to go in some of those names, especially if we start to see maybe a resurgence of M&A. I mean, one of the companies I had gotten out of and never gotten back into got taken off the market like right there at the end of the year. A flatbed truckload carrier got bought by the big old Canadian trucker. But like, I would think that idiosyncratic plays where you have some sort of catalyst, you have some sort of corporate action, whatever, that stuff should, I think you should probably focus more on that stuff if you want to be tactical and not, worry as much about the stuff that we can't know, the macro stuff, the macro prognostications. Like, instead maybe, work on some special situations, dig into some deals as they come and go. Like, maybe that's a good use of your early 24 time if you're gonna be actively trading stuff like you say you are, Dylan. So that's what I would say. Maybe that's where you want to look, is like special sits. Can you get any good risk skews in your favor? I mean, this is one I regret because the Twitter deal, I did not have enough on the Twitter deal, and that was one that for a lot of people made their year, made them a lot of money. But like, if you get situations like that where there's agreement to buy the company at X price, and then there's a big gap, and you have a view that you've researched and well informed me. This JetBlue deal is the other kind of one going on right now. We've talked about it a bit, but yeah, I mean that's stuff to look at, like discretionary, special sits, yada yada.
That is something that's caught my attention. That's what I was supposed to be doing for the last several years, was trying to find these identifiable sources of alpha. I will say this: I had some friends blow up last year on the short side, and I had some friends blow up on the long side in 2022. They just continued to hammer leaps, and they just kept going further and further and further. Got taken out, and then three of my friends got taken out in the bear market. And when I say taken out, I mean their accounts are at zero. So there have been some people washed out. I guess. Do you ever and I guess maybe this is a bad year to talk. Well, no, actually, last year was a good year. Do you ever just think about passive investing? You know, when I look at like the
No,
QQQs, they
I'm
return.
terrified of what's going to happen. I don't know when it's going to happen, but to me, what's happened in 23 is not sustainable and is emblematic of there's there's no such thing as free lunch, and there's no such thing as just an ongoing manna from God. Like these some of these mega cap companies have seemed to have gotten thanks to index inflows, and if you get a like Apple, to me, Apple could trade down 50%. A 50% haircut would get that closer to fairly valued, in my view. I mean, it's just, what is the upside versus the downside in some of this stuff? And I think the issue is that people aren't even thinking about that if they're purely on passive autopilot. Like they're not necessarily thinking that if I'm in SPY, whatever the choice is, like you're so exposed to a handful of American technology companies that have a variety of their own risks and are all near extremes in their valuations. Like, I don't know. To me, I couldn't do passive because I think about that. And like, I think to each their own, right? If you're not really interested in this stuff, then you probably should do passive, frankly. And even if you are really interested in this stuff, you know what? Maybe you'll come to find after several years, right? Like I thought maybe I was, and who knows? I still have, you have to see over a long period of time. There's just a lot of noise in returns. I mean, my returns the last 2 years were below the passive index, but the if you go back like a 5-year CAGR, it's still quite elevated above. But then again, it's like, well, where are the sources of that? So I don't know. I don't think I would do true, like just pure passive. I would probably want to pick some managers actually, because I do think that more than ever we're in the type of a market where choosing an individual security is going to be a better outcome than trying to just be all in on the index when the indices are on many measures. I'm not saying we're just ever no, but I mean they're very above normal levels, and those doesn't mean they can't get more stretched, and we can't have this scary right tail bubble reflate.
No, you're right. And the reason I brought up passive, I look at, I'm celebrating my fourth. This is the start of, actually January marks the start of my fourth year in markets on my own. So I live off the P&L. I don't have a day job. And when I look at last year, actually shorting AI names cost me my outperformance. And in my
I
two
was short
years,
tech almost all year, so my year was crushed by tech.
okay, then now I should say this: when I look at like my 6 years in markets, I've outperformed four of the 6 years, and then now the outperformance has been well over what passive would have earned me. But because when you outperform, you're usually outperforming by a ton, and then I think about it, and it's just like I'm spending all my time focused on trying to think I'm smarter than the market. What really happened is I read a Jeremy Siegel book, and he's got some wisdom. I don't really agree with a lot of things he says on CNBC, but he has some wisdom. But I just was just wondering if you had any other thoughts. But I see that we've gone over that topic. Yes, AI was a very expensive lesson for me, right? Because I watched these companies that all pivoted to AI in 2022. so many of them were just talking about the metaverse. Like I remember, Nvidia when it was 269 and and this was in the spring of 2022. Jensen's talking about how metaverse is going to be the thing, and there's going to be digital clones of factories, and they're going to go into the metaverse and they're going to do production on these factories, and then that way they'll know what production they need to do in real world. And now you don't even hear about the metaverse anymore. So I thought AI was somewhat of a bubble, and that cost me outperformance in 2023.
I mean, digital twins have been around for decades, I think, at this point. So I don't know what that notion is that's new and improved over the
You were supposed
existing
to be able to
industrial world's
walk
digital
in there,
twins.
is what it was. Is you were going to be able to walk in there and you were going to be able to see the designs, and they were pitching it as a means of doing industrial production.
Mm.
And again, this was NVIDIA's, they do that spring conference every year. This was their spring conference in March of 2022. And then when I saw them completely abandon the metaverse and switch to AI, I remember thinking, well, this is just the next thing that they're gonna use to pump the equity. And it turned out that Nvidia would go on in 5x. And I was
Yeah, I'm
like,
looking at
wow.
my unrealized loss on some NVIDIA put options that expire in 16 days, and that was not a fun one. Um, I lost some money shorting the common as well. I mean, I just like I hate to sound bitter. I just think these the fucking tech bros have gotten bailed out and had such an astonishing run. Like they're not worried about downside. They don't even think about risk. They don't even think about margin of safety. And I think a lot of them need to get wiped the fuck out. And I don't know when that's going to happen because it seems like the Fed and the Treasury are actively working to ensure asset values do not go down.
No, and that's why I was, so I have one position on, and my one position for the year has been slaughtered, unbelievably slaughtered. And when I go to look at equities, when I go to allocate for 2024, I just think, again, you have a lot of favorable factors on your head. I know you're old enough to remember 2019. 2019, I was up 70% and the markets were up 35%. That was when we had three rate cuts. And I just, I question is that already priced into the market, or is it going to go higher? Are we going to be talking about, a 5,000 plus SPX, this year? Because, I remember how crazy it was in 2019. And in 2019, what I did, Rod, I didn't have very much money. I just bought in January, like January 3rd, right when Apple released, they released some very bad news about production, and it turned out that was their low of the day for the entire year. And then I just held on and I just watched equities just completely rip. And I just questioned if we're about to have another, issue where another situation where the Fed is going to cut rates. People are going to look at the risk-free rate. They're going to look at the rate in money market funds going down, and they're just going to pile into equities. Whether it makes sense or not, I just wonder if that's what's going to happen.
So let's talk about Apple. Apple's price to earnings growth is just shy of the highest level it reached during the COVID bubble. It's higher than at any other point X the COVID bubble, since the GFC, right? Price to earnings growth, you're paying close to 30 times earnings for a company that's growing earnings at, let's call it high single digits. So all else equal, you want a lower PEG, you want to pay less for that growth. So yeah, Apple's growing, it's a great company, yada yada. I have a brand new iPhone thanks to Verizon giving me $830 in bill credits towards the 10s that I bought off eBay for 126 bucks. So like, but then it gets back to, okay, so Apple, you need to grow earnings, which you can take price, and you have, and they've aggressively taken price on services. But there's like these companies don't go up to infinity, and I think that people are back in that mindset of these things can just keep going up, and they're only going to go up, yada yada. Like I think about the PEG for Costco, for example, another one. Like I love Costco, but the PEG is almost 5.5. It's the highest it's ever been, and it's like it's gone from pre-COVID. The PEG ranged from, let's call it, two, like in the years of like 2014, because it got some multiple expansion in 2014. Let's call it 2014 to 2019. It ranged from 2 to 3, 3.5. Okay, and all of COVID though, the PEG has been kind of above 3, 4.5. Now it's at 5.5. Like, people are paying obscene amounts for, like, again, okay, 40 times earnings for Costco, and because of the balance sheet, you need to play around and make some adjustments to kind of get like for like. But regardless, that means that they're growing, again, mid high single digit earnings growth, and you're paying 40 times for that. Like, it doesn't, it's not setting you up to succeed over, you could go 5 years and get hardly any return if these companies just see their multiples compress somewhat, which is what I expect is going to happen. So, again, it's like everyone has piled into so many things. I get what you're saying. Oh, we got cash on the sidelines, so they'll just buy more of them. So I don't know. It's definitely better to be looking ex-US. US equities, got to look in small and mid, and even then, you can be careful. There's so much crap out there. So I don't know.
No, I hear you, and that's why I thought China was attractive, and that's why I'm looking at equity exposure from China. I do see several people on my feed calling bottom on China. So and I should say that they're not. They're someone that I would actually take investment advice from. They're not people that I think don't have any clue what they're talking about. So, and then commodities has been a very popular trade that I've been hearing talked about. Although it's you have to go with commodities if you believe the economy is fine, which I tend to think the economy is fine. So
Yeah, I think that's
I've
what I
been
was
looking
trying to
at.
get at with talking about energy and materials earlier.
So it's funny you mentioned energy. I remember when oil was, and actually I was trying to figure out how to buy oil futures when oil was like 65, and I remember thinking if the economy is fine, which I think it is, it should probably go a lot higher. And I did trade some oil, and that was where, I remember thinking I'm making $2 or $3 on a contract, thinking I'm smart. I'm like, oh, look how smart I am. And then oil ended up ramping like $20. Now that was in part because of the Israel-Hamas war, which I did not see coming. But it's like had I been a long-term investor, I would have exited my oil, at 85 or 80, $90 or something.
Yeah, if you were a long-term investor, you wouldn't be buying barrels of oil. You would own an E&P, or you'd own the company that gets you that exposure, probably, right? Like, I still have a big chunk of EOG shares. I've been like hemming and hawing about trimming it more, going back to what I was saying about Ecopetrol and Petrobras earlier. Like, but again, it's within the context of my own personal situation, which remains very, like, I'm multiples higher than the S&P allocation to energy. So when I say trimming, it's like, oh, instead of being 5 times the S&P, I'll be 4 times the S&P, allocation if I trim, back. So, again, it's all relative. And like you mentioned earlier, a lot of people that are always just talking their book. They're trying to sell you something, and you know that. But I'm not trying to sell anyone anything. I'm just trying to talk about things.
No, and I hear you 100%. One thing that my friend tells me, who's a PM, he tells me that most of the people on this app have been bullish since 2022. He's convinced that this, Twitter is just a bunch of noise. Because he goes, the great opportunities that were presented, in 2022, most people didn't have cash to buy because they never thought markets were going to go down. And that really was only the bears that had cash to buy because they were bearish or they had short positions. And then some of them didn't go in and take opportunities, which, again, I'm guilty of some of that myself, guilty of trying to be a trader instead of a long-term investor. Like Rod, when I think of it, I unloaded Meta at 112. At 112, and it's now like 350. And it's like unbelievable, unbelievably stupid not being a long-term investor versus being a trader.
Yeah, we'll see what happens with that. I think that again is another example of how ridiculously spoiled tech investors have been. They got a modest down year, 1 year out of 15, and now we've got this resurgence of the mania and the bubble. I don't know. I think it would be great to have a true washout, wipeout moment. I don't think that happened in 22. I mean, I hear what you're saying. Some people, zeroed themselves out, but I don't think broadly we got anything like what I think is owed. Like again, it gets back to the notion that the idea that a bottom for the US 500 at 15 times with risk-free rates having risen to where they are, and whatever, let's assume that what you said is right, that we get 150-ish by the end of the year, so we're back under 4, 375 Fed funds. Like, still, okay, where should the 10-year be at? I think it should be north of 4 in that in that scenario. It is below 4. So, like, how much more moderation are you really getting in the 10-year? Sure, you're getting moderation on the front end, and the folks who are smaller and more variable should benefit. As they took it on the chin with rates rising and everyone flooded into the megas, it should revert itself, right? If we get that loosening, then all that money that flowed into these, very interest insensitive, well capitalized mega caps should find itself flowing out somewhat. So we'll see if this first 2 days is the start of more. But on the other hand, well, IWM is down 5% over last week. Nasdaq's down 3, S&P 1.5. So I don't even know what to think.
No, I hear you. What did you think this selling is? Did you think that this was tax loss selling? Or did you think that,
profit taking, yeah, and I think there's absolutely got to be some of that going on the last 2 days. That I don't know if you were in the room. I said, and I've seen people make the point. It's valid that I'd rather wait to sell on Jan 1 or 2, Jan 2, 3 than December 30th, whatever, because now I have an extra 360 odd days to pay the tax on that, and that has value with rates where they are. So I get that notion, although has the equity not declined more to offset that? Perhaps, who knows?
no, and you make absolute case. For me, I always did my tax planning where I wanted to make sure taxes were paid. I always set aside money to make sure that I did pay it, whereas a lot of people, I don't know why they like to offset their tax gains, because I think they intend to continue to speculate with their tax payment, which then means if you lose it, you're just absolutely screwed, because then you have to sell whatever remaining assets you have left to cover the tax bill.
Just throw it all in Bitcoin, bro.
You know what? I will say that I remember Bitcoin being at 16,000 this year. No idea that it was going back to 45,000. And if I did know, I'm an idiot for not buying it, because it's ramped up 3x from when it
These
started the year
motherfuckers
in
have to
January.
get wiped out. These fucks have to get wiped out. We can't have a normal economy until this madness is purged.
Well, I'm just wondering how much crazier it can get, because again, I was around in 2021, 2020, and I was in the most speculative garbage you can think of. Again, Nikola, we had 20% of the net worth in Nikola, and it was part of what allowed me to do what I can, because the thing ran 300%. Again, the common equity ran 300%. Rod, I sold my Nikola at $92 a share. And like, you think of it, the company was a complete fraud. I mean, we had some really, really crazy times. I wonder if we're going back to those insane times, because when I look at times and when I look at how it was in 2021 and 2020, I mean, things can get a whole lot weirder if we're going to go back to that environment. And I'm not just talking about what happened with NFTs. I mean, conventional equities, not just
So
options
it's
and
funny because
warrants.
I worked at Ryder at the time, And I'm looking back at the chart. Ryder had terminated the services partnership it had with Nikola, like right when that was going parabolic in May of 2020. So I wasn't able to transact in Nikola, but man, I wish I could have just gotten some shares short at at what could have clearly proven to be extraordinary levels. I mean, it's down almost 99% from the highs. And still, I mean, it's almost $1 billion market cap.
Yeah, 2021 was
What?
a crazy time. I mean, I remember Dogecoin is something I put $40 in as a joke back in 2014, and at the peak when Elon Musk was about to speak on SNL, it was $40,000, and that's literal shitcoin. Like the definition, the first ever total shitcoin worth nothing became almost worth $1. It was a crazy time. I actually did spend half of the Doge on a T-shirt that doesn't fit me anymore. So worst $20 I ever spent back when it was worth, my total sum was worth 40. That T-shirt, at the peak would have been a $20,000 shirt. So not so hot there. Now Dogecoin's fallen down pretty far, not worth nothing, but still worth quite a bit less. And we also had just the stuff that was going on with NFTs back then. I mean, I remember somebody gifted me a .eth, like some name, NFT like name, and just from having it, just from like being gifted it, maybe cost the person $70. I was given an airdrop worth like $3,000 or $4,000 just because I owned some ENS name. So I never really grasped my head around that full project, but yeah, I remember just the money that was being thrown around for free is just astronomical.
Yeah, it was a total money grab, and I wonder if we're going back to that. Part of me thinks about the behavioral finance aspect of markets, and when you look
No,
at
we're already in that. I mean, it's already happened. It happened over the course of most of last year, and will it continue is the question. I mean, can it
well,
get
Rod,
back to 21 extremes? I don't think so. I don't think there's enough cash flowing from the government directly into consumers and to speculators' pocketbooks to enable, what akin to what happened in Jan 21, right, when those stimmy checks hit and enabled so much, market moving thanks to the power of leverage. I mean, you were talking about futures, right? Talking about options. People can get so much buying power and leverage with such a small amount of principal. I mean, it's definitely, it fucks with people. It's fucked with a lot of people, right? If you make outsized returns, then through some wonderful speculation, which again, we all like to think that we got it right because of our own prowess, and then when it's wrong, it's because of somebody else's fault. I mean, shit, a lot of it's just luck. Come on. But if you get lucky, I got very lucky with GameStop. I got very unlucky in some ways. I think I mentioned this to you, and I mentioned it to Joe in the chat. Like I sold in early January 21. So early January 21, the first week of January 21, I sold off almost all of my GameStop call option exposure because through the crowdsourcing of order numbers, I saw that their holiday sales results were going to miss, and I expected them to report that on or around January 11th. And I made a Reddit post saying as such. Little did I know, the same day that they were going to report holiday sales, they announced the settlement with Cohen and RC Ventures. So the stock was instead up, let's call it 10%. And I never got those back on. And had I exited with them at my average exit of my other positions, the incremental Forsaken gain was $5 million. So, playing the what if game is not constructive, I think. And it's very easy to say, oh, if I'd sold Bitcoin here or Doge here or whatever here. I think it just detracts from, trying to position yourself with these sorts of different skewed scenarios where the downside relative to the upside is in your favor. And even if you have a 90% chance, there's a 10% it's not gonna pay out. Like, yeah, probability and probabilistic thinking is tough. And I think it's just very easy to run with, a hot hand, or on the other hand, like you said, if you are making those sorts of bets and you find yourself on the wrong side, you could find yourself with zero quite quickly in your bankroll if you're trying to martingale and you forget that martingale, eventually you're going to run out of bankroll and you can go to zero quite easily.
Well, I just when I look at markets, I think how much hard, when I look at markets right now, I think this is hard mode. When you think of where markets were 12 to 18 months ago, that was easy mode because everything was so beaten up that there was so much upside versus it's like, okay, if I buy Meta, what am I how much longer am I going to have to wait for Meta to double versus, when you were buying it at $100, which again, I sold my shares at 112, so let's all laugh at me. But it's just like when I look at markets, you wonder where's the next trade, where's the next source of alpha, and this is where I tend to think that people get pushed out on the risk curve, and this is when you really run into the degenerate speculation. And I wonder if
I don't think that
people are
ever
going
really went
back to that.
very, very away. I mean, just the survey results of like investor expectations of returns, they've remained near historical highs. And it again, it Marx, I think, has called it out in some of his memos, this notion that you know unintelligent risk taking has been wildly rewarded for much of the last 15 years. It was wildly rewarded last year, I think. Unintelligent risk taking. I think it was quite unintelligent, some of the risk taking that people took in the years preceding that. But that's what I mean. Like the notion that October 22 is the low, so to speak. Again, to have the low at what would have really been more like an average level of valuation, like a mid-teens, earnings multiple on the S&P, that was not a low to me. Like a low, we'd be getting into the low teens. Who knows, right? What will be the reason for multiple compression next time? But multiples do not just keep going up, and I still think there's people who have not learned that lesson, and they've been rewarded for not learning the lesson. So why wouldn't they? Why should they change their ways?
No, 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 and you're right, and that's where I get into 2024 allocation, where it's like you don't think Meta is going to be a $700 stock, but you're allocating to, okay, what
Do you
hasn't
think
run
British
yet?
American Tobacco is worth a 7 PE
Yeah,
over a 6? I do.
I used to have an allocation to them. Actually, I had a more longer term portfolio that included some tobacco stocks, oil stocks like PBR. PBR was in my name. These came from friends, of course, and then I liquidated all of them, and because I just wanted to start with a clean slate for 2024. But no, I had some conservative name, and you know what? I couldn't understand about oil stocks, or sorry, tobacco stocks, because they just kept getting killed. And I'm looking at them and I'm like, okay, these things pay a 10% dividend or 9% dividend, I should say. I'm like, why don't people want to buy them?
And that's with a
And it,
65% payout. It's not like they're paying,
yeah,
at least BTI.
no, yeah, and I was in BTI, and then and let me see what BTI. Now I've sold it, so let me be clear. I just exited like 2 weeks ago. Okay, so BTI is still at $29, but it's like I, I always wonder, is there something I'm missing about the sin stocks? It's why aren't people buying these for their dividend? And maybe it's because they're only buying it for the dividend. They don't see upside in the fundamental
Well,
business, meaning
Dylan,
your
no
equity is going to
one
appreciate.
passive is buying British American Tobacco. There's part of your problem. Again, I guess I've definitely felt my mindset shift more toward Jesus Christ, having a brain fart. Einhorn. Einhorn's notion like that the market's become more inefficient with passive growing and growing, that people there's no like discovery of the real intrinsic value unless there's a takeout, or unless there's uh the company is an active repurchaser of its own shares. Like there's got to be some catalyst to realize these value disconnects. And that again, if you're buying some of these, Coinbase, right? Like the thing, I've been short Coinbase since the lower 100s, so it's been frustrating to watch it continue to go up. But it's like you just look at the actual numbers that underpin it, and then you look at the actual what what is the Bitcoin ETF mean? It's like these things are not going to lead to anything like the value that's been baked into this equity. And I get it. It's just the market is very casino-like still, especially the retail-centric securities. But to your point, could it go even more extreme than 21 or 2020? Like I don't think so, because I think that requires even more fiscal spend. It has to be more direct fiscal spend into consumers' pockets, like we saw. So I would go down a limb and say we don't see that level of extreme mania again this year, at least. I bet. Ben, you think it's going to get that extreme, or you think it could? Ay, ay, ay.
I
Scared.
mean, I can't believe Coinbase was up 419%. And again, I couldn't get myself to buy this name below
Why would you? I have
$40.
not understood a well-articulated bull thesis for
And
Coinbase.
that's why I didn't buy it. But again, I looked at this name when it was $40 and I'm just like, the crypto business is over. That's what I legitimately thought. And then to see it, end the year at like $180 or something, I'm just like, wow, you you completely missed the idea. Now I will say that there
Well,
was a
you
lot of
didn't
people that
think
were
that
short.
Coinbase was going to go from 2 times EV to sales to 11 times EV to sales?
Yeah, it could. Well, I thought largely I thought a lot of those guys were going to get blown up. I thought a lot of crypto guys were going to get blown up in 2023, and but I debated buying it a couple times under $40 just as a speculative asset. Can't believe I couldn't pull the trigger. I couldn't do that on a couple of names where I just couldn't risk the capital on these very speculative names, and then they all had massive returns in 2023, and I'm just sitting there, my jaw on the floor, and just being like, wow, I didn't get the memo.
Yeah. I can't bring myself to do that sort of dumb shit. And that's fine. I'd actually rather be right than make money. And that's why I know I'm not a trader. Ben, what's going to happen that's going to make the mania even more than what we had?
No, I'm on board with what you've said. I mean, there's just, I mean, the direct stimulus in the COVID era, that was the fuel, that was the gasoline on the fire.
The
The
rocket
the
fuel, if you will.
Yeah, the rocket fuel for the I mean, that was what rocket fuel on top of QE4, was it? Um, like you just, or was it QE4 or QE3?
QE infinity.
QE4.
It was
QE4.
QE infinity.
Yeah, QE. God, and I remember I did post something way back in March of 20. I think it was March or April of 20, somewhere in there, um, where all these people are like, "Oh, the Fed just fired their last bullet," and I posted
Bro,
something.
they fucking just did a Goku spirit bomb, absorbed all the power, and they said, we have unlimited power. There is no dearth of spirit energy that we can destroy you with.
And I commented on, I got to go find it, but I commented on one of those things, and I was like, you have no idea how many fucking bullets are in that gun. Like there's it's like one of those like movie guns that I hate, where it just has like, this bottomless clip, and they've been firing it on full auto, or not,
No
bottomless
recoil. They've been
magazine. They've
holding
been
their arms sideways, and
Yeah, bottomless magazine. They've been firing it for 5 minutes on full auto. It's they
yeah.
haven't reloaded one time. It's that same sort of thing. Like that was, and I said it wasn't going to be a V-shaped recovery. I said it would be a lazy V, which is pretty much what we got. Um, but yeah, like, I mean, when you just pump that much, especially the direct stimulus was the big thing, because like I knew so many people, like just regular ass, like
People were getting paid more than they were when they were working back to
exactly,
work. I mean,
exactly. Yes,
that's
people were
a
getting paid more
not
money to stay at
universally
home and
true,
do
but
nothing.
very widespread truth of the
Very
federal
much.
pandemic unemployment program.
And that's just not there anymore. Like, I mean, that's, I think, why we saw so much concentration last year, because at that point, you're kind of got to pick your shots. You got to, and that's why, last year everyone just kind of concentrated into Mag 7, and um, you know, you pretty much didn't outperform if you didn't do that, outside of a few special situations. But um, like that was, last year was, honestly, like that was really telling, I think, when a lot of people were just kind of piling into, not a lot of people, but a handful, especially on the institutional side, were just piling into the highest quality names, because like what else are we going to do? Like given like the rate environment and everything else, they just didn't want to, kind of venture outside. I mean, I remember, like what Dylan was speaking to, like Nikola and like how many other SPACs, like you just buy the SPAC on the day that they announce the target, and you sit back a week later, you sell, and it's like a 10, 20, 30x. Like it was insane. Um, and that's just, when everyone was chasing that, and how many of those are, now trading for pennies? How many of them gone bankrupt? It's just,
And how many people learned that you never sell and to diamond hand and have diamond handed their CCIV/LCID from from double digits to single digits.
so I had a customer come by today, long time customer, good guy, not that bright on investment stuff, but he bought 40,000 shares. According to him, he bought 40,000 shares of Mullen,
Oh God.
like a while back, and he's like, "Why do I only have like 3 shares now?" He like didn't understand the mechanics of like a reverse split. I mean, this guy, he couldn't tell you the first thing about this company. Um, he just bought it because he thought it was cheap at the time, and this is like a fucking 50-year-old grown ass man. Oh, is Rod having problems? Oh, he's back.
Sorry.
Um,
I don't know. Elon booted me and now he let me back.
but yeah, like it's he. I'll DM you the thing he texted me too. Um, it's kind of funny but kind of sad because it's so representative of that weird period of mania where everyone and their mother's brother was trying to be a stock picker. Um, yeah.
I mean, Dylan, I guess to get back to the essence of kind of what the discussion of what do you do in 24, I mean, I'm inclined to think you inverse 23 broadly. The stuff that got slaughtered in 23 is probably going to outperform the stuff that had, some of its best years on record in 23. It's like a long China, short big tech. I would think that's going to actually, and I'm not recommending anyone to put it on. I mean, my China exposure is low single digit. Um,
I would be so careful with
yeah.
China.
No, I mean it's just the notion that sentiment can always get worse, but sentiment's pretty damn washed out. And if you just have any reversal of the outflows from China, like a lot of these equities, if you believe their financials or if you believe you have a claim on them, are pretty darn cheap. No,
I mean, China was technically washed out at the start of 23 too. So
true. Can always get worse. We value investors know
Yeah,
this.
and there's some bottom callers on my feed. They're from people that I would trust, like Alliant and Stack, and there's a few others that are they're bottom calling China. I will say that I did look at SE, and when it was like 35, just purely speculative bet, it's rallied a little bit, and I was like, you know what, I can't go back in and speculate in China after
I mean, SE is not
my last
China though.
losses. No, I know, but it's Singapore. But I worry that it gets
It's
lumped
funny.
in there. And
Another security I own a pretty big personal stake in. It's like I think it's like 6% or so right now. Gravity. It's a video game company. It's South Korean, but for whatever reason, it trades very sympathetically to China, even though they had no China exposure. They're actually entering the China market this year, which will be interesting to see play out. But they trade at like a 1 times EV to EBITDA on a trailing basis. It's like that company is its own issue because of a lack of capital allocation. But there's a lot of really cheap stuff ex US you can find if you dig around. But yeah, to China, anything that people think is China, you're right. Sentiments in the shitter. Dylan, I have like 70 bips long C calls. Um, June 50s, Feb 45, Jan 40.
Yeah, see, I was short SE, and I was short SE when it was 360 at in Q4 21, which is insane to think because the stock is now $38 and it hasn't split. And there is a distinction between trying to go long some of the names that you were short. I will say that that is difficult for the guys that could do that in 2009. That takes an unbelievable talent because you're basically just inversing your thesis.
I wish I had sold all my GameStop and gone short GameStop at 420.69.
Well, there would have been no shares to borrow
You're
because
right. I
I
wouldn't have
tried to
shorted
short.
Common. I would have written absurd amounts of contracts,
Yeah,
calls, and
because
puts.
like Nikola was a classic example. There was no shares to borrow. At least for me, I couldn't get shares. Same thing with like Airbnb and DoorDash. When DoorDash was like $180, 170, I tried to find shares to borrow. There was no shares to borrow. And then Airbnb had the same way. Now they weren't SPACs, but they were recent IPOs and no liquidity to get. Or at least I couldn't get it as a retail investor.
Real quick, almost always a broker issue. If you if you really if you like regularly short stocks, or especially if you want to regularly short stocks that are hard to borrow, you have to have some sort of an account with Centerpoint Securities. I haven't had one in years, but when I did, like when nobody had to borrow, those guys would. Um, might be a little pricey, but Centerpoint almost always has a borrow available somehow, some way, and it's not like a Cayman Islands sort of thing. Like they're not just trading against you and like boxing your book. They're actually finding the securities.
Thank you, Ben. Yes, I'm not. I have no short selling plan, but that definitely is something. I mean, I would much rather make money as a short as opposed to a long. But trying to make money as a short seller professionally, I mean, that's got to be probably the hardest thing you can do. Probably one of the hardest careers you can do.
I just love watching John Hempton's feed. Honestly, he's a delight, and it's nice. It's nice when we're not getting thumped.
Sean is so good. Um, and I can't even imagine doing that out of Australia. But also, shorting is like if you want to do something that's going to teach you like how to like legitimately manage risk, run a short book. In my opinion, that is the one way. A great example, and like again, like I think I think Rod and I have talked about this before, but why Gabe deserved to blow up. You could buy an outsized hedge on GameStop and just a call position for nothing, for pennies on the dollar, for just to completely take your book to where you'd actually be asymmetrically hedged, where you make money on your short if you blew up.
I'd love if he
Um,
would do. He won't. He never will. But I would have. I'd love to hear like the timeline from his and their perspective over the
yeah,
course of both 2020. I mean, because it didn't start in
fly on the
2020. It
wall.
was 2019 when those buybacks bumped them up to more than a third of the shares out. Like again, the issue is a lack of asymmetry in the visibility, and I think I thought that was unfair, right? If you go over 5% long, you have to file in a timely manner, unless your name's Elon, and you get a slap on the wrist. But you should be filing, on the appropriate, whether it's G or D 13, within the right period of time. Well, if you're short, as they were, an inordinate amount of the company, there was no disclosure requirement. So, I wasn't the only one who figured out they were among the big shorts. The long hedge funds, who some of whom I'm sure poured fuel on the fire in January 21, knew that Gabe was up shit's creek without a paddle. But it gets back to your point, Ben. Like why would you be short a third of the security? And when it got to points where, what was your upside? Like, was it you just, again, you didn't want to have to realize the taxable gain. You didn't want to have to potentially sell along because I'm sure they were running levered, right? Like,
Yeah, of course. Yeah,
just
degrossing. No, this is the thing I talk about all the time is like put the hedge back in hedge fund. Like just this is a fucking really pretty simple philosophy, a concept that's apparently has just gotten away from everybody in recent years. Like when you see somebody getting carried out on something that would have costed them, pennies or just, single digit, IRR to hedge against in the event that it goes really against you. Or if excuse me, it would cost you, single digit IRR if it does not go against you, just to protect your fucking book. Like, why is that? Like, again, I'm confused by it. I don't think I'll ever understand it. But it's this again, like this whole idea of hedge funds are traditionally are supposed to be hedged, and not just by being long indices. That's a fucking misnomer and a misconception, but just having asymmetric hedges in places where if you're really wrong, you actually get paid. And there's a handful of people out there doing that, but not enough.
Yeah, Ben, that's totally true. I mean, the notion is the prototypical hedge fund is trying to not lose money, trying to have steady, low. I guess it's all going to depend what type you are now, but like you're trying to have less drawdown in the market, return at or above the market. But you're right. There's not as much of the actual hedging that you referred to by many of them, it seems. And so much of it, I mean, there was the Bloomberg write-up. It was a few weeks back at this point. It was earlier in December, kind of talking through how much money is in kind of the fast money, the pod shop universe, and what happens when you get these massive shifts, right? These guys are levered to the tits. So if there's a few percent drawdown, their stops are getting hit. Like we just haven't seen what happens yet when you get because we just don't know what we don't know about what happens in an unwind when all the pod shops are racing each other to get out. Now they're all selling the same longs, right? Like I just think that's an untested kind of bad outcome that's going to happen in the market at some point in time.
I'd actually disagree with that. We have a really good example via Mark Cahodes at Copper River Partners during the Great Financial Crisis, when their firm was levered to the hilt, and they shorted the whole on financial stocks. And then, of course, because unfortunately, Mark Cahodes never has had an original idea in his life. He just chases everything. But they shorted the whole on financial stocks right before it was announced that they were basically going to ban short selling of financial stocks, which led to them blowing up because they were super levered. I think roughly 3 to 3.5x, which doesn't sound like a lot, but in practice, that is a lot. Um, um, but no, like I think we've seen that already play out. I mean, and like, yeah, you see like the degrossing, like where all of a sudden, long positions start going up for against
Well, the
weird
difference then is
shorts.
the scale of market participation that those shops represent today versus then.
Right. And I think it's less now because I mean,
No.
who doesn't want to just run
Mm, mm,
passives?
okay, hang on. I'll let me find the data and come back with it.
I know you're going to get the data. That's why I love you.
All right. So it was on November 30th is when this write-up got published. Joe, let me send you the link. So I don't know if you can just pin it.
Yeah, go ahead and send it.
the multi-manager pod shop assets have grown from in 2012, looks like touch over 55 billion to now over looks like 220 or so. So that was just a handful of shops. So okay, the 55 pod shops oversee 368 billion, about half controlled by the five biggest firms. That's up from 29 running a combined 149 in 2018. So from mid-year 23, over 5 years, you saw the money more than double. So let me send Joe the link, but I don't know that this specific article has the exact data, but I guess the notion is that all else equal, they represent a larger mix of market participants in dollars and on percent of dollars, and therefore, what happens just given the way that they are all kind of structured to, we need to cut our losses quickly. So I don't know if you saw that one, but
I mean,
I mean, look, I hear what you're saying about the Coyotes situation. That's a little.
and I know about like the rise of pod shops, but that's just basically replacing existing traditional hedge funds.
Mm,
I mean, I do want to look at the data, but I would say that you'd have to kind of graph it against, again, like your traditional, just like LP shops.
Multi-manager firms now hold 30% of gross market value held by hedge funds in US stocks. That's up from 27% last year, largely because of more leverage. I don't know. Yeah, I don't know these numbers inside and out relative to like GFC era. So let me not, compare them without having that. But of at least the past, 10 whatever years, this level of concentration, I think, has grown. That seems to be the notion behind the story. One fund manager estimated that a dozen firms were doing index rebalancing. Never mind. Never mind. That's irrelevant. I mean, it goes back, though, to the point you made earlier that the Fed does not have a limit to its bullets. And if there is a stressed situation, as we saw 9 months ago, they will act accordingly. As we saw, almost 4 years ago, they will do what they got to do. And I think, who knows if something will come along that they can't really do much about.
They already did it with BTFP. Like, who saw that coming?
Yep. They will conjure up a program to ensure that assets do not decline in value. Anywho, it's 8:30. Logical, you came up. I'll let you chime in before you do. Just about 30-minute warning, folks. I'll probably dip out here at the top of the hour.
Yo, due diligence just invited me up to speak, so just didn't really have much on my mind other than I think there's a lot of opportunities for sure. And personally, I don't know until I see some sort of bearish, like reason to be bearish. I'm still feeling like we're going up from here. And I mean, looking at history, like here's how I look at it, right? Everyone is so convinced that we're gonna go lower or we should sell off and all that, but it's like, dude, we just spent
Most of the
2 years.
sentiment surveys are at pretty extreme levels of bullishness. I haven't
I
seen a
I,
view
I
contrary
don't
to
know.
that.
Twitter is definitely, I guess, probably a bit.
Oh, well, stocks went down for a day, so the
Yeah,
Twitterverse is in shambles.
right. No, exactly. No, but that's what I'm talking about more. So, like, honestly, Twitter is probably a decent sentiment gauge. I mean, like, there's definitely value there, but I just feel like today has been just completely bearish, and it's like, it's just funny how wild things swing. A month ago, we're feeling like, stocks have bottomed in a lot of areas, and then it's like a couple days of red, and now it's like, oh, I wouldn't pay, 18 times earnings for that. It's like, dude, are we seriously doing this again? Like, the answer isn't fucking 25 times sales maybe, but it's also not like 2 times gross profit or whatever it is, you know? So I think if you're paying attention to a lot of like interesting names, got a good watch list, you're probably gonna do okay because, dude, I mean, I think just trying to trade off the macro has been tough. You guys mentioned like BTFP, and I got real bearish. I definitely I shorted banks back in March, and I my problem was that I saw them do the whole BTFP thing, and I stayed bearish, and I think that was a big flaw that I understand now and gave back a lot of unnecessary gains. So looking forward, it's like until I have confirmation that things are actually broken, I'm not gonna like just try to be some sort of I'm not gonna try to forecast or predict my own things based off whatever theory I have. Can things get weaker? Sure, we're coming off like big GDP growths, but I still think that a lot of these companies are misvalued for what they're kind of offering. So looking in specific spots, I think, is your best bet. And
Where do you
yeah,
see the most extreme misvaluations?
I've been saying it for years. I'm big on biotech. So I think that like, and now we're seeing M&A pick up. And if there is a promise of lower rates, this is kind of my perspective is that, well, one, for the last couple of years, I mean, we had a ton of cash raising, and sure, a lot of these companies are preclinical or shouldn't be public, but still, these guys are trading at like below cash values. We're at like a historic number. We're at a historic record level of like number of biotechs trading below cash. And then you have like this added tailwind of you have a ton of these big biotechs with a lot of cash on the balance sheet, and they were just sitting in T-bills. And now that like there is talks of rates coming back down, they know that those yields are going to disappear on their money, and shareholders are going to expect some sort of investment on that capital. So they're probably going to start shopping around, especially while there are so many deals, small deals. You get to buy that drug pipeline. And if you wait, your competitors are just going to pick up your targets. So I think that there's going to be a race. We've already seen a lot of M&A pick up. So biotech is definitely somewhere that is very rate sensitive, and even just the appearance or speculation of lower rates will, I think, start moving the needle because it won't take much. The sentiment has been in the gutter for 2.5 years, almost 3 years. Like literally, the bottom was and the top was February 2021. We're like halfway off the highs, and it is fucking 3 years later. Like so looking at the index returns over the last 20 years, like you'd probably get 10% down year and then like 4 years of straight like 20+% gain. So seeing a nearly, I mean, if we didn't just have such a strong rally the last couple of months, we were about to finish a third year double-digit down year for XBI. So I mean, that is a very much a obviously there's still more garbage now, but because they all went public, but in the index. But the thing is that they're also sitting at record low valuations. They're like negative enterprise values. So I think, yeah,
Yeah,
you could pick
that's
something
a
up.
very good call out, and I don't disagree with the notion that there's probably good to be had within that pile. But just as an example, at least for me, of why that's not a pile I'm going to even touch, I look at the XBI, the biotech, and I don't even know. I only know Moderna out of the top 10 fund holdings. I don't even know any of these companies except Moderna. So, like for me, it's just going back to I don't think you were listening in on the early kind of part of the monologue back around 7 o'clock. I was like, one thing I've learned is let me not go beyond my circle of competency. Ben and I
No,
have
that's
talked many
fair.
a times about kind of like transports and industrial stuff that we I think both understand. And for me, having worked in corporate strategy at Ryder, kind of seeing the whole ecosystem, if you will, from equipment to the various logistics services and all that. Like I think that's one thing we probably take for granted when we work in a space. We know it, so why don't we invest in it? And that may be true for you with bio, but I'm just saying for me, that's why bio is like
No,
I
I
don't know
mean,
it at all.
I work in data. I would love to own Snowflake, for instance. That's like I use that product every single day of my life, and it's probably one of the greatest like innovations in the field. So I would love to own that stock, but I also can't justify paying, like whatever the absurd multiple is now. I mean, actually, it's starting to look a little bit better as they grow into their valuation, but like it still doesn't look appealing on a forward return basis. So just given the starting size and whatnot. So like I mean, yeah, I agree with you generally that I'd like to invest in things I already know based on my career. But the thing is that most things in the tech data field, I mean, I'm basically I'm a data scientist, so I do like a lot of machine learning, which is all the AI hype right now. So buying something that I actually know about is probably not even a stock I can likely justify based on valuations.
As a retired biotech nerd, I have to ask, like, what you're bullish on in that space specifically.
Well, I'm actually mostly long LABU, which is the degen in me. It is a 3x leveraged XBI ETF, so it's clearly a lot more aggressive. I caught it when XBI was trading at like, I don't know, 72. I missed the 65 bottom. I was like tweeting about it. I'm like, I think this is the time. And I should have listened to when the CPI came in cooler and the FOMC called the rate. Like, I think I took actually a position before FOMC, yeah, like 11:22. So I think Labu, I mean, it just reverse split or reverse merged. So the share price went up. But yeah, so I think my adjusted cost basis is at like $73 and it's trading at like 115, 120 now. So I caught a pretty fucking chunky move. But I'm bullish. And like, I personally don't think deal flow is going to stop anytime soon. You have JPM conference coming up in a few, I don't know, few days or whatever. And so a lot of catalysts. There's a lot of like companies daily lately posting really good data. I'm seeing fucking some random biotechs. I talk to a lot of guys who own a bunch of biotechs, and they're a lot of their positions. They take like a bunch of small positions and basically play out the probabilities of success on their data readouts. And dude, I've seen a couple of these stocks going up 200-300% these last few days. And like for instance, I bought Ceto Connects, it's CYTK, and I just took a small position. And dude, that thing rocketed like 100% overnight. I knew they were going to read out the data in the morning. I was looking at it in after hours at 42, and I was like, you know what, this could be a sell. The news are already up 30-40% into this data readout. I didn't buy it, and it went up 100% the next day. And I talked to a lot of smart people on here, and they think that based on recent M&A that's gone on, this becomes like a prime candidate on this phase 3 readout, and they can see the price of the buyout being anywhere between 50 to 100% higher. So I bought a small position in that, for instance, and I think we're going to see more M&A. So I'm generally bullish XBI. So even if like the market participants won't bid up these small companies trading below cash, I think you can easily have the companies within the biotech space to bid up these companies. You know what I mean? So just kind of raising all boats. Like for instance, like if you have a company that's trading at like, let's say, 300 mil, or let's say it's trading at 200 mil, right? And they have 300 mil cash. You could pay 400 mil for that company, basically pay 100 million enterprise value, because you're going to get that 300 mil back into the bank and you just adopted their pipeline. But all those equity holders that were holding it at 200 mil are getting a double on their investment. So I think that you're going to probably see a lot of good deals go down. But I've taken I'd say like a 5-6% position, but it's via a leveraged ETF. So the exposure is definitely much higher. But watching this thing go in for a 2-3 year bear market, I feel like at some point something's got to give. And we just fucking beat a pandemic. So I don't know like why sentiment for biotech is so low at this point. But I think it's something that can probably change quickly. And another thing would be like I'm also very, very, very bullish small caps in general, just given the historic low valuations relatively and absolutely. So I think those are two things that, especially as rates come down, will probably do well. And that's most of my portfolio is like individual names, small caps, micro caps. Yeah.
But again, like what specifically like are you bullish on in the biotech space?
I mean, I think that over like again, I think that there's going to be a lot of need for capital allocation. So I think one, I'm very bullish on M&A continuing, which that would be a big catalyst, honestly, into this year. What am I bullish on? Like what specific trends and themes? I mean, the reason why I'm saying that I'd be bullish from an investment standpoint, though, is more just like things are very, very cheap, and I think the time is kind of like now that we're going to start recognizing a lot of value. But yeah, theme wise, like I just took a position in a company called MXCT, and there's guys like Peter Mantas, who's on here all the time, and Deep Sail Capital. They talk about this one, and basically it's just a partner to a gene therapy, uh, different like cell editing, gene editing therapies that are basically on the cusp of entering trials, and so it's something that's going to become really big in the future. And this is like a picks and shovels way to play it, and they're like a 400 or 500 million market cap with like 250 mil cash on the balance sheet, so pretty cheap valuation and a good starting point for something that can end up becoming much larger down the line. So I put it in my long-term account. So that's position I took just this week. But I mean, dude, like I'm very bullish a lot of different parts, I guess, but I don't necessarily own them either because I don't think I'm smart enough to pick a winner. Like I think something like anything that's reliant on FDA trials, like they have something in the pipeline, like a therapeutics company, is too hard to play, and you're basically rolling the dice. Like I don't care if you're a PhD, like they can fail or not pass at any point in the trial. So I'm not there to call out specific things like that, but like let's say you have a company that's a partner to many companies that engage in FDA trials. Like for instance, there's Charles River Labs, CRL. They're basically on all of these other companies' FDA trial applications, so their moat is extremely high. So you can't really replace the products that CRL provides their partners, because if you did, then it would like go against like the study that was done in their FDA trial. So once you have a partner, you're basically signed up with them for life. So businesses like that are pretty interesting to me, and I think a CRL is probably going to compound for years and years to come, just given how essential they are. But then if you look at players that look like them or can look like them, 10 years down the line in terms of size, I think looking into who's kind of leading these newer fields of biotech, again, it's going to be a longer term investment, but you probably take out a lot of the, uh, risk of the individual company when you buy at picks and shovels versus like going after a specific therapeutics company. So yeah, picks and shovels, I guess, would be how I'd play any kind of these, um, different areas.
Maybe I can answer your question, Ben. And I also reiterate logical thesis sentiment on biotech. I think you're going to see a golden age of biotech. The last time biotech took this big of a beating was the late 80s, early 90s. So almost 40-year drawdown in terms of like the size, the velocity, and the veracity. So this is sort of biotech's GFC. And it's not just rates, it's a culmination of other factors, including the IRA, Inflation Reduction Act, NIH budget cuts, obviously COVID overhang, which has impacted life science balance sheets to a degree, and obviously the NHP issue, which was caused by the Biden administration. But in terms of your question, Ben, the three areas that I think, if I'm looking into 2030s, number one would be ADCs. So this is anti-drug conjugates. For people in the space who may not know what that is, think of this is basically next-gen chemo. A lot of companies are focused on oncology, and the conspiracy theory in me is they're really focused on these mega deals in ADCs because of the side effects of what biologics will do. And I guess that's the second theme is biologics generally, so cell and gene therapy, and monoclonal antibodies. I think those are the three big areas. And if I would put a fourth, I would say oncological immunotherapies or cancer vaccines. It's probably the fourth bucket. But yeah, those are the areas that I think you're going to see a lot of money being thrown around. Because if you look at pharma, they're looking at Merck's Keytruda drug, and everyone's like, I want what they did. And for people who may not know, everyone talks about Ozempic, but Merck has a drug called Keytruda, which is a cancer drug, and it's been an absolute horse of a drug, hit drug, 25 billion in sales. And the reason for that is um, it's been in like 1,000 combo trials. And so drug companies love combo trials because that just expands the addressable market for the usage of the drug and can theoretically extend the patent life. So the areas where that is most common is in oncology. So yeah.
Yeah, Keytruda is an oncology. It's a survival extension candidate more than
Yeah.
anything. It I mean, on a good day, you live. On a bad day, it gives you some more time with your family.
Exactly. Yeah.
That's unfortunately the way that one goes down. But also, as you kind of spoke to, the same kind of bullish catalyst that you have to me is a very bearish catalyst, which is biological similars. Because we've essentially taken a lot of teeth out of the competition by allowing biological similars where you can, I mean, that's in my opinion been the single biggest down, but let's call it headwind for XBI over the last 2 years or so. Whenever they passed the biological similars that allowed those to go to market, where it essentially passes a lot of like patent stuff. It's
Part of that's in the IRA as well. And AbbVie is case in point with the biosimilar. Like they've just been hit with Humira generic.
right, but the IRA just encourages more biosimilars, which is going to destroy value for all the people that have patents.
It depends. Like it really like on rare diseases, it's going to be really hard for generics to do biosimilars in that area because some of the stuff, like for example, the stuff that Maxight's doing, is very physical. It's very in your face. It's autologous cell therapies. It's things that where you're taking the patient's blood out of a cell, out of their body, doing a 6-hour procedure, using Cas9 and then putting it back in their body. For things where it's like um, Humira or like simple syringe-based biologics, like COVID vaccine is a biologic. For things like that,
Yeah.
I think you're right. I think you're right. Anything in liquid nanoparticles, I think you're probably right. Um, But look, like I guess the other catalyst too is we have an election coming up, and if Republicans take, half or even have a Republican president, you might see a reversal in the IRA. The sad thing with the IRA, what it does, and what's been happening is it bids up phase 3 companies. So like Bristol Myers recently bought Raise Bio, which is a phase 3 drug company, and they bought it at like 11 to 12 times sales. And unfortunately, what happens is you get the compression on the preclinical companies, which are XBI components, and you get the expansion on the phase 3 because it's closer to commercialization.
Yep.
And nobody wants to invest in R&D anymore. So that's what the backlash for the IRA is. I do think companies will have more time, and I think that the patent cliffs are really, really, really big. Like big pharma. There's a note up by Stifel late December saying it's the biggest patent cliff in mankind in history of the drug industry. So you have almost 500 billion of patents coming due. So these guys are going to have to buy, and I don't think they have a choice. So whether it's preclinical or even phase 1 or phase 3, I think everybody is going to benefit over time. Yeah, that's sort of the high level thematic.
No, I appreciate it. I just, I, I think my big takeaway with just the biotech space in general is that with biosimilars being allowed, not only allowed but encouraged, is going to destroy and take away a lot of value in that space. It'll ultimately be great for the end consumer, which is not to sound like a fucking commie, but I think that's how it should sort of work out. But like, unless we're going to pass something that gets rid of biosimilars, biological similars specifically, and of course too, like you have this whole thing now where like Moderna is talking about doing mRNA vaccine therapeutics for cancer, and like they've only like released the most basic preclinical stuff on it, and everyone's getting really excited. But like motherfuck, like if you actually look at the science and like how a nanolipid particle, transfers this stuff into a cell, doing that with a virus, which like physically and like on a genetic code sort of level is very, 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 very small and minuscule compared to an oncological candidate. Like I don't think that's going to work. I think that mRNA is Moderna honestly is ultimately a fucking zero.
Yeah, I don't know. That's a bold call. But in terms of like some of the major themes, there are major programs around liquid nanoparticle mRNA cancer vaccines from like all the big drug companies. I don't think it's going to be. I think it's still early. I think the cat's not out of the bag just yet, but there are companies actively developing in that space. But when we're talking about investments, we're talking about like what are some of the major themes that are real and tangible. And yeah, biosimilars is a risk, but like that's like part of one segment of the market. There's like other drugs like in cell and gene therapy that are really complicated, and I think generics going to have a problem. I think insurance is going to have a problem, right? I don't know what the answer is. Like, let's say you get a Parkinson's drug approved for like a cell therapy, it's going to cost you $3 to $4 million a shot.
Yep.
And there's 1 million Parkinson's patients in the United States. Okay, so United Health's going to have to do like a DCF saying, okay, like how do we pay for this? Maybe the answer is like, yeah, we do pay for it because right now the alternative for Parkinson's patient is a DBS procedure, which is 30 grand a pop with like constant upgrades and maintenance, and plus other kinds of drugs for like the rest of their life. Whereas like maybe a one-time cell therapy, cure them and it's over. I don't know. Like it's hard to say. I don't. Those are question marks I don't have answers to. But that's sort of like the world that we're going into. So if you think about it, like some of these drug companies, if they have a hit for a large indication, like an Alzheimer's, it's going to be very expensive. So
Short every single Alzheimer's drug on the market.
yes, none of them. All those drugs are symptomatic. Like they're how do I say it? They're just like amyloid plaque. But if you really want a cure for something like Alzheimer's, it's got to be something like a cell therapy or gene therapy, which is very,
Yep.
very, very difficult. Very difficult to do. So if someone figures that out, then great, right? Same with diabetes. Like CRISPR, all these guys are trying to figure out a CRISPR way for diabetes. If they figure that out and it's legit, yeah, Dexcom's 0, Pod's 0, Novo has got a problem, but we're not there yet. And I think there's a lot of, like those are very difficult problems to solve, right? So, I mean, just like here's an example, like sickle cell, the sickle cell approval, which is groundbreaking. It's effectively a cure for sickle cell. I've seen the FDA AdCom. I read all this on this. This is unbelievable time that we get to see effectively a cure for sickle cell. You're seeing patients who are hospitalized for 250 days a year coming out like a new person. Okay. The problem is that this is a MaxCyte program, as Logical Thesis mentioned MaxCyte before. This drug costs $2.2 million. The problem is that it's a very physical thing, right? Like it's very hard to roll these out. Vertex is the key partner on this. They're already trying to figure out a way to deliver this in a pill. Like that's going to be very hard to do. Putting large molecules in small molecules, which is a pill, is going to be tough. So, I mean, maybe they figure it out. I have no idea, but this is the kind of world that we're in for biotech. You have these like, there's no point in humanity where we've seen the level of tailwinds that the sector is facing, but also seeing the biggest drawdown that it's ever had in the last 40, 50 years. And that's where the opportunity is, and that kind of echoes with the high level thesis that logical thesis was mentioned before.
Yeah, and that's basically like I feel like we're just like talking the same, two different sides of the same coin. Where like a lot of incentives, because I mean, obviously, the 90s, the 2000s were like a golden age for biotech, where people would just throw money at you for whatever. And the thing that I kind of nestled into and specialized in for a little bit when I was like cutting my teeth in public markets, was specifically hepatitis and liver drugs, because obviously the two are directly related. But that was a big thing. Like people like, oh, like we're working on a functional cure for hepatitis B, and I'm like, I'm looking at their studies, and I'm like, the fuck you are. Um, it was just, eh, and it's still going on. Um, and occasionally, every once in a while, like I come across, some new liver candidate, uh, and they're trying to recycle someone's abandoned, orphaned fucking drug bullshit from you know 10 years ago, and it's still happening. Except we don't have as much funding there because people aren't just willing to blindly throw money into biotech anymore. That was the penny stock du jour in the early 2010s specifically. Um, I just see overall, like, I understand what you're saying as far as like possible bullish outcomes, but I just see way more downside catalysts, and outcomes. And call me a pessimist, I don't care, but um, I mean, tell me tell me why I'm wrong. Um,
I think we're missing the forest from the trees. We're saying that the setup for biotech from a macro perspective has never been better, and obviously there are certain technologies that are questionable, but there are technologies that are also very legit, like the
and,
sickle cell approval, like some other gene therapies that have been approved. Like we're going from a world since 2017, you had one gene therapy approved per year, and now you're getting like 6, 7, 8, 9, 10, and that's only going to go higher and higher and higher.
but you
And
also
so,
brought up CRISPR, and like you should know that like that was the great white hope, and it's been thoroughly. I mean, it was supposed to be a scalpel, and it turned out to be a chainsaw. Like I was all over that in like 20, what was it, 15, 16, like when that was kind of starting to gain ground, and it was going to be like the next big thing. It just it didn't actually work out in practice.
I mean, there's a lot of hype around it, but the company's legit. This approval is game changing for them. It's precedent setting, right? And that's another thing too that we want to maybe I want to talk about, or maybe I can build off logical thesis. Bullish sentiment is this is a sector that thrives off precedents because precedents create funding catalysts, right? Um, so when we talk about an FDA approval of a sickle cell magnitude or some other kind of key major drug, it creates the VCs start to look at this and say, well, I want my program to be approved using these tools now, because now the FDA is going to say, I'm not going to tell you to use a Maxite or a Repligen or a Danaher or a Thermo, but it better quack like a duck, look like a duck, and walk like a duck if you want your drug approved. And every day that your drug is not approved, terminal value shrinks. So I'm very bullish on the sector, and when I see major, game-changing technologies like a sickle cell or like other approvals crossing the FDA line, um, like we're going to see a wave of approvals. I mean, this past week, I mean, not this week, maybe before New Year's, the FDA set out a protocol document for best practices for manufacturing your CGT program. I mean, they don't put that out unless they're preparing for an uptick in approvals or applications that are going to come from the space. So, yeah, I think generally speaking, it's probably a good time to look at the sector. And if you're not a biotech specialist, where you're going to see a lot of the value accrue is going to be in the bioprocessing sector. So think of like your Thermo Fisher. Danaher, Sartorius,
Like
Repligen,
CDMOs?
CDMOs, Lonza,
Oof.
Maxite,
But isn't that,
Cerepoint.
you don't think the CDMO space is crowded right now?
I just want to be with the best. Lonza's the best. Like just be with Lonza or Samsung Biologics, right? Like those are the top two in my opinion. Thermo's trying to build one out. Danaher might acquire one because it's an attractive space to be in. And when you're dealing with sensitive programs, like if you're dealing with a drug that costs $3 million, you don't want to screw it up. So you're going to hire the best of the best. Speaking of like Alonza, Merck's got CDMO in Germany, Wuxi Biologics in China, Samsung Biologics in Korea. So those will also see value accretion. People like to talk about Catalent. I'm not a big fan of Catalent. Too many missteps, too many risks. And Charles Rivers, as logical thesis, they have a CDMO. They actually just built one this past year. They're putting a lot of money into the manufacturing capacity to produce viral vectors.
Well, it looks like we lost Rod. Um, I mean, for whatever the fuck it's worth, I'm generally pretty bearish on the CDMO space just because it's became so crowded, especially with all these companies coming in like, oh, we have an AI solution for this or that, and they obviously don't. Danaher is a different story. Are you Canadian?
Yeah, I'm Canadian. Yeah.
Oh, how did I know? Sorry, I knew because it was the Danaher plug, which is a great company. Definitely, you know.
And Danaher's not Canadian. It's an
Yeah,
American company.
Yeah, but for whatever reason, the Canadians are super into Danaher. Like that's just something I've noticed over the years.
That's probably because of the Constellation software sort of.
Oh yeah.
You talk to if you talk to the guys who are really involved with Constellation, they idolize Danaher. The Danaher business system is literally what Mark Leonard tried to copy as a culture in Constellation.
Yep.
So
That checks out.
They're in love with that. I spoke to the CFO of Constellation one time, and he told me if we could be anywhere close to what Danaher has pulled off, we will be very happy. That's sort of like they really idolize that culture and that company.
No, honestly, I think Danaher is a great company. It's on my shopping list, watch list, in case there's like a washout.
Yeah.
How about this?
Also, it's pretty much gone now. But I had a short call about 4 or 5 months ago on a CDMO whose ticker is actually CDMO. When it was like $9 or $10 a share. They're overbuilding capacity. They're putting way too much into capex. It's at like $5 a share now. But I think you're going to see a lot of these CDMO players kind of going in that direction because again, it is legitimately crowded, especially the smaller players, like the smaller market caps. It's not pretty.
Mm-hmm. Logical, you were going to say something?
No, I mean, just trying to go back to what we were talking about in general. Before I mentioned biotechs. I know it goes down a tangent, and obviously there's different viewpoints. And I mean, I've clearly made my bet in which direction, but I think that, biotech was just my first answer, but there's a lot of things right now that I think are poised for a good year. So I just think there is a lot of stuff to be kind of optimistic about, and I think if you maybe don't buy the Mag 7 this year after the incredible run they had last year, I mean, I don't think that's like the only, I feel like people get confused with, you have to be bullish everything, um, just to be bullish. So I think there's a lot of places where it's been extremely depressed and valuations don't make a lot of sense. And if you compare it to like the relative opportunity in a lot of these large caps that were growing like crazy, and I mean, like obviously growth software did amazing last year. And I thought it was still pretty expensive before the rally, and now it's just even crazier. I don't think I'll ever get there on names like that, but obviously growth continues to win. But if you could find growth in something that, has yet to appreciate to a more reasonable valuation, I would call it. So I think that's where you kind of find some sorts of margin of safety is still having a grower. I'm not talking about like find super cheap stocks because a lot of the time you're probably missing something. It's probably a value trap, and so I know GARP is a kind of a cringe word, but like literally finding something that still has growth in it, probably underappreciated. Like I'm pretty bullish on ad markets for the next year, especially. And I know I'm not trying to talk about like long-term investments on a one-year basis, but there's a lot of sectors and industries that are cyclical, and I got wrecked in some of these names in post 2021 and 2022 when ad market kind of hit a recession. We had all those layoffs and companies tightened their belt with spending, and I think ad budgets were like one of the first to go. But you're coming out of that now. You had better results in Q3. You're going into Q4, which is seasonally the strongest. Then 2024 is an election year. So you're going to see, again, increased political campaign ad spend. So I'm bullish a lot of names like that. Small caps specifically. I think, because there's obviously the trade desk, but they're always, at a premium valuation. You could own like the Googles and the Metas, but I personally am I tend to go for smaller names with bigger opportunity to take advantage of, and maybe that is a losing move, and a lot of times people just call it a beta bet on like the sector versus like owning a Google. But I think beta works both ways. So when I feel like right now we're kind of on the way up versus a couple years ago on the way down, probably odds are in your favor. So riding beta might, make sense in some environments. So um, yeah, I think also like the large guys like Google and whatnot, like they're facing antitrust cases, and like obviously these guys typically don't lose too much when they do lose. So, but the thing is that like even losing a couple percentages of their business, their ad business, can turn $1 billion companies into like you know adding like billions of dollars of revenue to tiny companies, and that can actually move the needle quite a bit. So even if that turns out to be a call option, you have a lot of payout. But again, just even the core business is profitable with higher volume in the ad market, better pricing. You'll see that operating leverage come through on the way up. So I'm very bullish on small ad tech players like Pubmatic and Magnite. I think they're both pretty well positioned. And yeah, man, I think you're coming off of a 2-year bear market for small caps, and everyone wants to shit on them. But it's like, I think that if you like, there's been a lot of studies. If you focus on, if you strip out IWM of all of its, zombie, over-levered, unprofitable companies, you actually end up with a basket of stocks that have pretty high returns over a long time frame. So if you're picking, small caps, and you're picking, the growers at reasonable prices and they're profitable, I think especially after coming off like a 2-year bear market, I mean, some of these stocks are down still 85% from their fucking 2021 highs. So I think there's a lot of opportunity if you're paying attention, and these things have been unloved, and everywhere you go, it's just like sentiment is, oh, look at the idiot small cap investors, and just own, Nvidia or Microsoft. And when that becomes a sentiment, like it's probably time for rotation. Actually, I like uh there's a guy on here, a junk bond investor or something, and he had posted literally on the day of the bottom on 10/26 saying like never own emerging markets, never own small caps, blah blah blah. And I remember commenting saying like, dude, that sounds like recency bias. And this is me when I'm getting shit on in small caps, like I'm still holding my same mentality. I don't want to forget those, you know, basics. And then we end up literally rotating into small caps for the hardest like 2-month rally ever. So I think when people think, it can only get worse, and in a lot of these times, I'm just seeing, oh, I'll be a buyer at X dollars, and that never they never end up taking the position. So I just feel like that's kind of been the sentiment is like, oh, these things will keep going down. So at some point they stop going down.
Totally. Good stuff, Logical. I mean, we have seen just the way small caps immediately reacted to the end of rate hikes. Pretty promising. Could end up seeing, the year of the small cap finally. I think people were
Yeah,
talking about it all last year, how it would eventually come. And who knows? Gotta really think about these things. People love to say, well, once it hits 15, once it hits 10, if some stock trading at 30, oh, if this was 20, I would buy it, and it's 20, and then they're too scared because it's going to keep going down. Plenty of that last year. Who knows? Will continue this year, but
yeah.
regardless, it is now 6:13 or so here in California. If you're on the East Coast, looking at like 9:13 or so. I'll let one more person give some thoughts, and then I'm going to end up wrapping it. We do these calls every Wednesday at 7 p.m. Eastern, and we do also do our weekly Wook and Review series on the @Wook Capital account, and that's at the market close. So if you're not following that account, that's every Friday. This account is every Wednesday. But if somebody else wants to chime in, add some final thoughts, feel free, and then I'm going to close it.
Maybe I can say something really quickly. I think one of the themes to look for in 2024 is find idiosyncratic risks. So the things that are top of mind for me, as an example, are medtech that got hit with Ozempic, staples that got hit with Ozempic fears, biotech as an example. You had macro rates plus all these other perfect storm creating idiosyncratic risks. I think if you can find those risks and you find the durable quality companies within those risks that might have overshot to the downside, you might find some interesting opportunities. And Logical Pieces presented some other markets like the ad tech market, which also faced a storm of some sort. I think that's probably the theme to look for 2024. If I can give my parting thoughts.
Thanks, Peter. Yeah, Logical. If you want to see something back, feel free. Otherwise, feel free. I'm going to wrap the conversation here.
I just wanted to say, yeah, I agree. Look for things that haven't performed or performed badly. It doesn't have to be small caps. I think there's a lot of value in still a lot of these laggard large caps, like uh, Hershey is an example of something I saw recently. But just you won't like it's kind of weird where you find value. So just keep your eyes open, and um, that's all I would say.
Good stuff. Go ahead, Ben.
Yeah, my closing thing is if you're going to play in biotech, honestly, at any level outside of an index, um, like if you cannot properly and accurately um, assess like studies and p numbers and things of those natures, then just don't fuck with it. Like it's so much easier just to. It's like a what do they call it? There's type one and type two errors. Type one errors are like when you're trying to like buy a stock at the top. A type two error is when you just don't buy it because for some reason you're like, yeah, this I don't know enough about it to participate, and like maybe it's you pass on buying Amazon at $1 a share or something, um, but you don't take a loss. And I feel like the vast majority of errors in biotech are type 1 errors, where people are chasing stuff that they don't know how to understand or interpret, especially when it comes to the study data. Um, that's all.
Good stuff. Totally agree with the bio industry on those thoughts. So with that, gonna wrap it here. Anyone who's participated, would love to see you again next week. This is every Wednesday, of course, hosted on this account. With that, cheers, everyone. Have a good night.